Great to see you here. If you're here for the first time or you're coming back to look at our videos and you didn't subscribe yet, this is the moment to click on the subscribe button and on the little bell so that you will be informed about our next releases. In this series of videos, we're talking about the project manager and decisions related to finance. The project manager has to understand the financial principles because decisions that are made have an effect on the profitability of the project. The time value of money is very important, and in this video we will talk about time value of money. We will be talking about the present value of cash flows. In the follow-up videos we will talk about the future value, the net present value, the profitability index and the internal rate of return. But let's now concentrate on the present value. When we have a project or an investment, the investment will generate, hopefully, positive cash flows in the future. Now, we may have positive or we may have negative cash flows. It depends on the situation. Now, what's very important, all those cash flows are in fact subject to the time value of money. $100 I will spend or I will receive in 10 years has not the same value as $100 here. We've seen those principles in our videos related to time value of money in the finance playlist. If you want to review those, these are in fact the basis for what we are summarizing in this video. Let's now have a look at a cash flow. We have a cash flow, or we expect a cash flow of 10,000 euros in 8 years. The discount rate that we estimate is about 12%. We have to estimate the discount rate, which is typically done by the finance people. But it's basically the weighted average cost of capital or the required rate of return, the rate that we expect to get in order to have a good project. Now, when we look at the discounted cash flow, the present value of that cash flow, we have to divide that cash flow by the factor 1 plus the interest rate to the power of n, n being the period at which we expect that cash flow. In our case, we expect that cash flow at the end of the 8th period, which means that we have to divide 10,000 euro with 1 plus 0.12, the 12%, to the power 8. And basically this gives us a value of 4,038 euro and 83 euro cent. We see that that nice amount of 10,000 euro that we expect 8 years from now only has a value today of 4,038 euro approximately. And it's important to understand what happens with all these cash flows and what their value will be today. We have a project, so we don't have just one cash flow, but we may have a lot more cash flows. So basically all those cash flows that we are expecting have to be discounted. And we want to know, in a new case here, a series of 6 cash flows, yearly cash flows, and we have a discount rate of 6%. So from the start of the project, 1 year at the end of the project, we have the first cash flow. So what we have to do is to get the value of that cash flow. The first cash flow we have to discount, and we have to discount it with 1 plus the interest rate to the power 1. The following cash flow at the end of year 2, we have 2 years, so we have to discount it with the factor 1 plus interest rate to the square. And we continue this till we reach the end of the 6th period. So the cash flow we expect at period 6, we have to divide by 1 plus the discount rate to the power 6. And we can write this as a mathematical summation where we go from 1 to 6, where we have the cash flow for each period divided by 1 plus the discount rate to the power of the period. So for the 4th period, that power will be 4. For the 6th period, it will be 6. So both equations are basically mathematical equivalents. When we have a simplified case, for example, we have constant cash flows, which sometimes can happen, but it's not always the case. We can use the formulas that we deducted in our videos related to finance. You can find how we found those formulas over there. And we can say that the present value for n cash flows, identical cash flows, is C, the amount of the cash flow multiplied by a parameter 1 plus the interest rate to the power n minus 1 divided by the interest rate multiplied by 1 plus the interest rate to the power 1. But we already spoken about Excel and other spreadsheet programs or financial calculators. They have built-in formulas. And for example, in Excel, you can find a formula which will give you the present value of repeating cash flows, identical cash flows, very quickly. It's the PV formula, and you have to put in there the rate, the interest rate that you're considering, the number of periods that you consider, the PMT, this is the cash flows that you are considering, but the number should be negative in the formula. And then we have the future value. Is there a future value that will be remaining at the end of the project, which can be the case? And the type means, are we looking at the payment or receiving the cash flows at the beginning or at the end of the period? The FE and the type are in fact two parameters that are not necessary. We can exclude them. If we don't put anything there, the computer or the program assumes we have put there 0. Now, when we look at a complex case, here it becomes a little bit more complex because we have an initial discount rate, we have an initial investment we will not use in this case because we're only looking at the present value of future cash flows, and we have those cash flows. Now, we have a cash flow at the end of year 1 of minus 25K, at the end of year 2 of 80K, at the end of year 3 of 75K, and at the end of year 4, 55K, and finally, we have 30K at the end of year 5. Now, we've seen in the finance calculations that we can use the net present value formula to find the present value of these cash flows. We only found the net present value when we subtracted the initial investment. And when we don't subtract the initial investment, which basically means there is no initial investment, we see that those future cash flows are calculated into their present value. So we just have to select the rate, the discount rate, which is in cell A2. We have to select the range of values that we are considering, which are in cell C2 till G2. And when we put that in the formula, we find that the discounted values, the present value of those different cash flows lead to a total present value of $176,569.15. Now, this is an easy way to do the calculations. You can use these formulas. You can use them when you are looking at changes in your project, when you are looking at some decisions you want to make. All these parameters will be very important to see what's going to happen with your project. And it's very important as a project manager, understand the financial consequences. You will be talking with people like CFOs, like CEOs, people who are looking at financial parameters more than just the simple outcome of a project. For them, they want to make a profit. And the time value of money plays a very important role in here. It will increase your value as a project manager. And of course, the more you know, the better you will be able to grow through the company and go to the C levels with all your experience as a project manager. This was the video about the present value. In our next videos, we look at the future value and all these other parameters. So this was the end for this video. Do not forget to subscribe, click on the bell button so that you will be informed every time we have a new video online for you. Thank you and bye-bye.